A very warm welcome to all our viewers to the 26th edition of Cedris Knowledge Series, an initiative wherein we have one speaker each month speaking on a variety of topics ranging right from investing to well being. We'll now play a short video of Cedris Wealth Partners. With budget being round the corner and market sentiment being so volatile, we all are curious to know what is the outlook that one can expect from this budget and how the macroeconomic parameters will react. Let us get all these questions answered today by none other than Mr. Arjun Nagarajan, Chief Economist and Communications Manager at Sundaram Mutual Fund. He has over 12 years of experience in the mutual fund industry. We'll now play a short video to further introduce him. A very warm welcome, sir. It's an absolute pleasure and honor to have you with us today. Uh, for all our viewers, this is a moderated session where we will ask our set of questions to Mr. Nagarajan. Meanwhile, if you all have any questions, you all can post them in the comment section and we will be happy to take them towards the end of this discussion. Uh, I would now like to hand it over to Mr. Prasanjit Bhattacharya, Director and Business Development Head at Cedris Wealth Partners. He'll take this discussion forward. Over to you, Prasanjit, sir.
Thank you, Unnati, for setting the tone of this session. Very good afternoon to all our viewers. Wish you all a very happy and healthy 2023. Actually, it is that time of the year when all of us are looking forward to the announcement of the annual budget. Since the time of the last budget, a lot of things has gone wrong across the globe due to the Ukraine-Russia war. Inflation has run ahead of the central bank estimates. Interest rates have remained high dramatically. There was a correction in bond and equity market across the globe and with enhanced volatility. So to start, Arjun, we would like you to share your report card of economic health of India.
Thanks a lot for having me, Mr. Bhattacharya, and thanks a lot, Unnati, for the introduction. So let me put it this way. India is actually in a fairly good space at this point in time. Why? I'll give you two quick reasons. One, we are largely a domestically oriented economy. There are external linkages, yes, and we do get an impact of global growth movements, but we are fairly inward looking to a large extent. That,
True.
in a certain sense, sort of cushions India's growth. So just to put a number out there, if you're looking at first level impact, for every, let's say, 100 basis points change in US and Eurozone GDP growth, the first level impact for India is around 30 basis points. This is almost one of the lowest in the Asian pack. So this has been one of the main reasons why India, in a sense, does stand out as an island of positivity from a macro front. The second reason why India is actually standing out was in 2020 when COVID hit us. Across the world, there was a significant amount of fiscal and monetary stimulus that central banks and governments had actually infused. Now, uh, any sort of a significant stimulus does have a downside in the sense that the once the stimulus hits, growth really picks up in a very sharp way, and once the stimulus wanes, the base effect catches in, and you start seeing a sharp drop, a sharp reversal in growth. We didn't really have a significant fiscal stimulus in the sense that whatever stimulus that India had done, it was very, very targeted and very calculated. So it was not a very significant boost, which means the way down is also not sharp. So we've really managed to sort of sail through COVID very well. And on the financial market side, especially from the RBI, the central bank, I think they've done a stellar job in really sailing through these last 2, 3 years of COVID. So I think that has been the second main reason why the way down is not very sharp. And
True.
because we don't really have this volatility, growth for India has sort of been holding up fairly well. Now, if I put a report card per se, I think there isn't any macro indicator that is pointing at weakness for India at this point in time. So there are multiple ways of looking at it. One is inflation. The other bit is the current account deficit, the fiscal deficit, your twin deficits, and then you have the external account, largely the rupee, and then activity indicators. So if you're going by the narrative, the earnings narratives that you hear, there is some moderation, there is some narrative of a slowdown that you can hear from the earnings season in December. But if you're looking at macro indicators, short frequency indicators per se, I think everything's sort of holding up. So I think the two most important indicators are your PMI manufacturing and your PMI services indicators. For 3 months now, they've been much higher than their previous month, and they've been much higher than market expectations as well. Now there will be some moderation that will come in because we started raising interest rates just after the Fed. It started in March of 2022, and I think we started around in April or May. So
Immediately.
you ideally have a catch up where the impact of these rate hikes actually start playing in, and you also have global growth coming off. So you will have some softness, but we're not really expecting any significant downside, at least from a growth point of view. So 6 to 6.5 on the GDP front is broadly a range that we're looking at for FY24. And our base case from a global point of view is also not a US recession. For nearly a year now, we've been talking about how US will not really be going into a recession. I think we can delve a bit more into the course of the session. But long story short, from a fiscal health point of view, I think we're doing fairly well. You will see fiscal consolidation in this budget. And the only point of concern, if I may, is the external sector, which is largely, it boils down into the rupee. The RBI has done a really good job in sort of keeping the rupee fairly controlled, and the rupee depreciation broadly in line with the emerging pack. So I think though the next 12 months you will see some volatility on the rupee front, I think the RBI has its game really set, and they have all the levers in place to see to it that there isn't any concerning sort of a move on the rupee front. To add to this, on the dollar front, there is dollar weakness that you can very clearly see from September of last year. You've seen nearly around a 10-11% drop in the dollar index, largely because euro has been strengthening. And on the back of this, you've been seeing emerging market currency strength to a large extent. I think I'll stop here. Any detailed questions, anything, please feel free to just type it in the box, and then we can take it after Prasenjit finishes his initial set of questions.
Yeah, thank you, Arjun, for that. I also personally feel that India is definitely in a very sweet spot as compared to rest of the world. In fact, if you look at the GST collection, that has remained above 1.4 lakhs crore for almost the last 10 months. Income tax and other collections in general have also remained above the budgeted estimates. I think 3.5 lakh crore above the budgeted estimates. If you can, if I'm right, if you may correct me there. So tax paying part of the economy has definitely done quite well. Credit growth, deposit growth, they have also been into double digits, for quite some time, and perhaps this is what we are seeing after a very long gap. Manufacturing PMI, as you mentioned, has also been, hinting at a expansionary mode. They have also remained high. So while India is doing so well, as you say, but the global headwinds still remain pretty strong, though there has been some kind of reversal in the trend in the inflation rate across the globe, but things do not seem to be easing out soon. So do you think that India will continue to remain as a opportunity that we see currently, as if it is one off case across the globe, or you will see there might be some pain in the Indian economy too going ahead?
Okay, I think that's a very interesting question. I'll just noting it down. Just give me a second. Okay, I'll just break this answer into three. So,
Sure.
from a global point of view, we will take an impact. I think there's no doubt about this. And the post 2000, I think it is very evident. You see at growth rates across the world, if the US slows down, if the developed world, largely the US slows down, you will see an impact across the world, across emerging market economies. So, like I mentioned in the first answer to your first question, I think the question is how much of an impact will there be? So, the statistical number of zero point 0.3 for every 100 basis points change in US and Eurozone GDP, which is G2 GDP, I think that is a positive, but nevertheless, that zero point 0.3 impact will still be there. So, what probably one would have expected somewhere around a 7.5% GDP growth for FY24, if the world was not going into a recession or the world was not going into a slowdown, it's now coming somewhere closer to around a 6.5. So that's, I think, broadly. So it is not a crashing sort of a number. Our steady state growth, even during tough times, has been in the range of around 5.5 to 6.5, and that's actually a pretty decent number to really, for an economy that's nearly 3.8 trillion in size, to really grow by. Now, on the global growth, or rather the recessionary front, I think there are two things that we really need to understand. So, as a fund house, we've been talking about this, rather screaming through the roofs nearly all of 2022, trying to tell markets and tell participants that this entire narrative of a US recession does not come from macro indicators in the US. It's now very evident now, but all through the Ukraine war, this was something that the markets were fearing. The entire narrative of a US recession stems only from one place: the fear that the markets had that to contain inflation, the Federal Reserve would raise rates very sharply, and that rate rise will push the economy into a recession. So it was the fear of the Federal Reserve's pace of rate hike that really had this recessionary concern. So, from a base case of 2022, base case of a severe recession that a lot of research houses and the markets were actually pricing in, the last 3-4 months has been made it very clear on the macro data front that that despite the fact that markets want to see much weaker US data, the data is still holding up very well. It is slowing down,
Yeah.
but the pace of slowdown is much slower than what the markets wanted to really see. So initially they wanted to see bad news. So bad news was good news was the narrative. Now bad news is actually bad news in a certain sense. So the short point I'm trying to make here is that there is still no macro data in the US that is hinting at a recession. The point here is that we have to always look at it in context. So during COVID, the amount of fiscal and monetary stimulus that the United States had pumped in was so significant that growth shot up multiple times above its trend. So it is just normal that it just normalizes, that mean reversion takes place. So the point that we're trying to say is that growth will come down in the US somewhere in the range of probably around 0.2 to 0.5% for 2023, but it will not really go into a recession. It will still stay above its long-term growth trend is all we are trying to say. So, what that means from an emerging market point of view is the fact that emerging market growth will not really take a undue sort of a disruptive sort of a drop in growth. That was the first point. The second point is from a Federal Reserve narrative point of view. Last 4 months, you've been seeing a very clear drop in inflation, and the last 3 months, it has been much lower than what markets have been expecting. So there is a lot of comfort that the markets have that maybe the Federal Reserve is not really going to raise rates maybe more than 50 basis points for 2023. I think nearly 60-70% were there. There's still around a 30-35% concern that the Federal Reserve has, because if you look at US inflation coming down, nearly a large part of it is because goods inflation has come off very sharply. Services inflation is still picking up in the US, so that is
True.
something that the Federal Reserve is very careful about. They don't want to give any sense that they are happy with the numbers unless and until they see services inflation starting to come off. And it's very interesting that if you look at India's CPI inflation and US CPI inflation, they are not even comparable. They're like chalk and cheese. So if you look at India's CPI inflation, around 46-47% of India's CPI inflation is directly related to food. If you
Food,
look at
yeah.
US CPI, 42% of US CPI inflation is related to rent, housing, and housing related. That is an item that is still a little sticky in the US, that has to really come off. But the base case that the markets are working with at this point in time is they're expecting 50 basis points of rate hikes in the US over the next couple of months, in the Feb policy and the March policy. And in the November and December policy of 2023, interestingly, they're expecting 2 rate cuts because they feel that the Fed is actually going to get very comfortable with inflation prints. They're expecting inflation to drop below 3% by June of this year. And they feel that the Federal Reserve is going to get very, very comfortable with this number. And by the end of the year, they will actually start delivering rate cuts. So from a global point of view, we will be impacted, but the extent of impact is definitely going to be much more limited. And the fact that the markets are now realizing the US is much more resilient than they had expected is putting a lot of cushion on the downside, both for the financial markets and for the macro numbers in the US. Last point, now, from a monetary policy point of view, whenever central banks start raising rates, you always have a lag impact, roughly around 3 quarters. So you can say around 9 months. It goes anywhere between 9 months to 15 months, depending on the economy. So you can go by a thumb rule of around 9 months. Around 9 months after the start of rate hikes, you will start seeing the economy starting to slow down because of the cumulative impact of rate hikes. Now, the Federal Reserve started raising rates in March, and so Federal Reserve always sort of is the lead indicator for all other central banks in the world, and all central
True.
banks globally started raising rates. So this Jan to March period, Jan to April period, will clearly see macro data, not just in the US, across the world, seeing some sort of an impact of these cumulative rate
Great.
hikes. So there will be some softness that you will see in the macro data. India is not going to be very different, but the only positive is that we have this cushion from an India point of view. Last point, trying to marry all of this from a financial equity market point of view, I think is that it is very important to understand that this entire narrative that you keep hearing of decoupling, deglobalization, I think it's time that we really call this bluff, in the sense, for the lack of a better word, it's just nonsense. We are in a globalized world, and since 2000, we have been neck deep in globalization. There is no way we can de-globalize. The simplest way, at least from a financial market point of view, I always feel talking macro is okay, is might be important, but the most important is you'll have to put your money where your mouth is, trying to map that macro to the equity markets. And if you do that, if you just take a very simple exercise, take 12-month rolling returns of the S&P 500 over the last 22 years, take again 12-month rolling returns of the Nifty every month over the last 22 years, you map them together, you will see that they move exactly directionally in line. There is no difference. The
Absolutely.
beta might be different, but directionally they're exactly the same. There are
True.
periods of divergences. The divergence maybe stays for around 2.5 to 3 months, maybe max a quarter. But beyond that, the divergence doesn't stay. The divergence happens on two counts. One, when India's macro is weak, India's markets, equity markets, diverge from the returns of the US markets. When India's markets are India's macro is very strong, then the brief divergence also happens, and then one catches up with the other. So, for example, if you look at 12-month rolling returns of the Nifty as of, let's say, December, you would see 4% returns. If you look at the S&P 500, I think would be somewhere around 10-11%, minus 10-11% return. So if you sort of plot the chart, you can see that we've been tagging US markets directionally on returns, but around September of 2022, we stopped moving in line with the US and we've been moving sideways. So now US is actually starting to pick up a bit because markets realize that they have been pricing in too much of a recessionary concern from a US point of view, and they're sort of normalizing that to a certain extent. And it's, I think I'm giving a very long answer, but just to put a quick number to this, in the June quarter earnings season in the US, around 85% of the S&P 500 companies beat expectations. Then the September quarter, 80% beat expectations. In the December quarter, 75 beat expectations, and now around 65 are beating expectations. So you still have more than 50% of the S&P 500 companies that have actually reported so far that are beating markets' own expectations of earnings, which is sort of giving markets a reassurance that, see, whatever narrative of a recession that you guys were talking about is not really playing in. And the markets and a lot of research houses are now moving their base case of a US recession concern to a mild recession. So this soft landing narrative that the Federal Reserve has been talking about, it looks like it's actually going to really happen. And maybe the Fed
Yeah.
has been right for once this time around.
Yeah, so there are talks of about 65% of the probability that the soft landing will happen. Um, yeah, so I mean, there is something which also comes to the mind here is that with the budget, so with, this is related to the budget. This year we have election in almost 9 states, and then followed by the general election next year. And that's a big event from an Indian democratic point of view, which definitely has a large impact on the economy as a whole. Most of the time, than not, we have noticed in the past that every election year, the government generally tends to keep the budget a bit populist. So, do you think that this budget is not going to be any different?
Okay, a fair question. So again, I'll try to break that up into two, three things. Um, from a fiscal deficit point of view, so let's say your fiscal deficit pre-COVID was somewhere around 6.5 lakh crores. That's actually nearly doubled post-COVID. So fiscal consolidation is a must, and I think this government really understands that very well. Because if they do not really consolidate on the fiscal front, whatever they do on the monetary policy front, whatever the RBI does, they really won't be too much of an impact because they will have to keep a lid on market borrowings. Because if on the gross market borrowing, on the borrowings number, if they keep going up, not in proportion to which the economy is actually growing, you will see an impact in interest rates, and interest rate hardening will take place. All of that happens. So they understand how the global linkages are with the domestic economy, and they really understand the importance of fiscal consolidation. So in hindsight, so when COVID hit, a lot of economists were talking about how we're telling the government that this is a one-off. Don't talk about fiscal consolidation. Just go and splurge on the spending. You really need to save the economy, etc., etc. Thank God they didn't listen to economists, because if they had, the debt to GDP would have actually touched almost close to 100%. And we all know once debt to GDP crosses 90% or crosses 100, bringing debt to GDP is a humongous task, which
True.
means nearly, let's say, every year, if you look at the amount of spending that the central government actually does. So let's say it gets around 27 lakh crores on the receipts front. But if you actually look at it from a expenditure point of view, they spend nearly 43, 44 lakh crores on expenditure, nearly 25-26% of the expenditure is just interest payments. So there
True.
is no way they can really cut back on that. And if you hit at 100% of GDP, cutting back is almost impossible. And then whenever there are periods of emerging market concerns, twin deficit, all of that, India impact will actually be much sharper and much more pronounced. So it was a very, very good thing that they didn't listen to economists. They really went by their gut feel. They said, no, let's not really splurge. Let's give all the stimulus in a very targeted way to all those places, those sectors that will actually need them, and at the time when they need it. So I think that's a positive. So from a fiscal point of view, 6.4 on FY in FY23, I think is a given. I wouldn't be surprised if they sort of bring in a marginally 5-6 basis points lower than what they had targeted, but I think 6.4% for FY23 I think is a given. Now the question is, what is FY24 going to be? Now, markets are a little positive. Markets feel that it could be anywhere between 5.7 to a 6%. I think 5.9ish seems okay. I think 5.9 to
General
6%.
consensus.
I think is a reasonable number. It's probably slightly above what the markets are expecting. Markets are somewhere around. If you take an average or a mean, it should be some in and around that 5.8 number. I think a 5.96% I think is a good number, is a manageable number. And what we have seen in the last few budgets, at least this political dispensation, has been very conservative on the receipt assumptions, and rightly so, in the sense that if you look at it from a budget point of view, the only thing any government has control over is the spending. They have no control over how much of receipts will come in. So it is very conservative, and it is a very practical thing to do, to keep the receipt assumptions to be on the lower side. So you always get positive surprises, and if those positive surprises come through, you can really tweak your expenditure on the higher side rather than doing the reverse. So that's what
True.
this government has been trying to do, and I think they've been doing so well so far. And if you're looking at FY23, they had budgeted your run rate on tax collections are nearly corporate and personal income tax are nearly 2x and 3x the run rate that they had actually budgeted. So that's
True.
actually given them much more room on the expenditure front. Even after the supplementary grant that they had actually come through, they're not really likely to breach on the fiscal front significantly. So this is one. So fiscal consolidation, I think, is a given. I don't really think there will be anything that will see a slippage on the fiscal front. The question is it going to be a 5.96 or a 5.8? I think that is largely the question. Now the question is quality of spending. So on the quantum of spending, okay, there might not be populism. On the quality of spending, if you look at the last general election time period, there really wasn't too much of a populism that you saw on the narratives front, on the numbers front. So this time around, populism can also be sort of delivered in the form of economic progress. So rural, education, health, I think these three are very clear areas they want to be focusing on. And I don't think one should be surprised if you continue to see rural, health, and education as focus areas for the budget. One positive is that on the fertilizer subsidy front, your natural gas prices are hopefully going to be much lower than what they were in FY23, because there is no war. I hope there's no geopolitical disturbance again. And on the food subsidy front also, you will see a much lower number. So this is very clearly opening up space to redirect this subsidy spending into other areas. Now, let me put it this way. On the best way to sort of judge spending is, if you look at revenue expenditure and capital expenditure, 80% of the central government's expenditure is revenue in nature. Only 20% is capital in nature. Now, let me look at this entire thing in a different way. Let's say you have revenue receipts and revenue expenditure. Now, if I calculate, so capital receipts is not something that the government actually can forecast very clearly. Capital expenditure, they can. But revenue expenditure is something that they really have to do. They have to pay salaries, they have to pay administration, they have to pay pay all of this. So this is a very fixed and a very sticky part of the entire fiscal mathematics. So if you try and calculate revenue expenditure as a percentage of revenue receipts, you will notice that around 75-78% of your revenue receipts is very, very sticky in nature. You cannot change them. You cannot change interest payments. You cannot change the salaries. So what we are
Yeah.
actually playing with here is 25% of the revenue bucket that you're actually looking at, which is not a very large sum. So one simple exercise, if you try and see, is in FY20 was a pre-COVID budget, and FY24 is going to be a post-COVID sort of a budget where I don't think there's going to be any COVID-related expenditure. So if you look at expenditure as a percentage of GDP, expenditure as a percentage of GDP in FY20 was roughly around 13%. And expenditure as a percentage of GDP in FY24 is likely to be somewhere around 15%, which means your expenditure has gone up by 2% of GDP in the last 2 to 3 years, from FY20 to FY24. There's a 2% of GDP increase in expenditure. But now there is no COVID now on the ground. So the COVID related spending is not really going to be there. So of this 2% increase, if I break it down as to how much of it is revenue and how much of it is capital, it will be very interesting to note that around 0.2 to 0.3% of the delta is revenue, and the rest of it is capital, which means that the amount of focus this government is placing on capital expenditure is quite significant. So we used
True.
to have a run rate of in and around 2.5 to 3 lakh crores. That used to be the capital expenditure of the central government. It used to be very, very stagnant for a very long period of time. Post 2015-16, you actually started seeing this increasing, and now this 2.5-3%, 3 lakh crores is now somewhere around 7.5 lakh crores. So you've seen a near doubling of the absolute capex spends, and the capex spends as a percentage of GDP has also really gone up. It has gone up by nearly 1.5% of GDP, 1.5, 1.6% of GDP from FY20 to FY24. So this is a very clear reflection of the fact that the quality of spends has also improved. Now one can argue and say, no, see, the FCI onboarding had happened, NHAI onboarding had happened. There's a lot of off budget that's coming in. It is getting disguised as capex. I understand, that's a very fair argument. But even if you look at capex, after taking these as one-offs, you will still see that the capex number is much, much higher than what it was. Now, let me give you another statistic. Say from FY 2000, 2001, from then on, if you analyze every single budget until around FY 13-14, you will notice that every single year there has been fiscal pressure. The government has always been trying to keep the fiscal in check by cutting back on capex. If you look at from FY 14-15 onwards, the exact opposite has happened. They have
True.
not cut back on capex whenever there is fiscal pressure. To the contrary, the last few years, you've actually seen them deliver more capex than what
More
they had
capex.
budgeted. So from
Correct.
a quality point of view, I think it is very much in place. Now, from a market point of view, I think has been a very long answer. I'll try to sort of keep it short. So, from a market point of view, one good thing is that the importance of the budget has been reducing over the last 6, 7, 8 years, and rightly so. It's only 25% of spending of that discretionary is actually there for the government to spend. And the budget is a place where the government gives a directional call as to saying, hey, these are the places we want to focus on from a directional point of view. It's not something that the government is trying to give from a speculative point of view. And I think that the budget is going in a very beautiful directional way. So even if you look at the VIX over the last, let's say, 7, 8 years, you will see that the volatility in the equity markets around the budget has also started coming off, except
Coming
for
off.
all those periods in time when you still have this LTCG, STCG, that narrative
Yeah.
always is something that creates some concern. So the only thing from a budget point of view, I think I'll wrap it down as 3 points. One, you will see fiscal consolidation take place. I don't think there will be any change in that. The directionality is going to be there. 6 or probably marginally below 6% of GDP, I think is what the government will come through. On the capex front, you will continue to see capex growth. The question is it going to be 20-25% growth, or is it going to be 15-20% growth? But nevertheless, it's going to be a high double-digit growth rate that you will see on the capex front. The other bit is you have two narratives, one around capital gains that's been there. Nobody really knows what's going to come through, but the narrative that you keep hearing is the fact that if you look at asset classes, you look at listed shares, unlisted shares, debt, equity, they have different timelines. The holding period is different for equities, for LTCG. Both the rates are different and the holding periods are also different. So there has been a very strong narrative about how they want to sort of standardize this. Now we don't know whether they're going to standardize the holding periods or whether they're going to standardize the rates or both. We don't really know. So depending on what they standardize on, there's definitely going to be something that an impact that will be there. And given that if you look at income tax data, if you sift through income tax data, you will actually see that a very large chunk of the LTCG collections that the government has received has been in the higher end of the spectrum, the higher income echelons of the segment. So from a point of view, if they want to argue this narrative of bringing down the inequality gap, that is a narrative that can definitely come through in the budget, but it's still in a speculative sort of a range at this point in time. The other narrative that could see is on the tariffs front. You see that there are a lot of electrical and electronic imports where the import tariffs are actually not there. So you say, for example, if you look at certain PCBs, and if you look at memory chips, and you look at other ICs, you have some import tariffs on them. But there are a lot of items where import tariffs are not really there. So at a point in time when probably the government is expecting some sort of a slowdown in global growth, and they probably might want to sort of cushion their revenues, import tariffs could be an area where they might want to touch upon, other than tax, if at all. I think these are the only two areas apart from what we've actually been speaking about that I think one can look forward to from a budget point of view. I know it's very 30,000 feet sort of a view, but nevertheless, I think it's a good thing that the last 6-7 years there's been a lot of de-emphasis from a budget point of view that the government has
No,
been
thank you so much. I think my own view and observations has been over the past few years is that budget has slowly become a non-event. Yes, there, as you said, there would be some volatility in certain sections, not with the consideration of what the government is going to announce in terms of expenditure and revenue. I think it is more from the policy directions that the government is ready to give. So that was a very insightful, session, Arjun. Due to the paucity of time, we may not ask you any more questions, though I have a couple of few, mostly originating from the discussions that we have been having. But I would leave it to Unnati. If there are any audience questions, we will take them. Mostly the relevant questions with respect to our discussions this afternoon.
Sure. Thanks.
That was an extremely intriguing session, sir. I think your perspective on fiscal consolidation in the upcoming budget and it being a populist budget has given us a view as to what one must expect from this budget. And fiscal consolidation being an important factor, irrespective of the monetary policy, this was also a very important key takeaway for all of us. Moving to the audience questions, my first question to you is with high GST and direct tax collections, do you feel government has any room to cut the income tax rates for individuals?
Yeah, that is a narrative. So the thing is that wherever they cut, if you look at tax data, it will tell you that a very large chunk of the tax filings come in those segments where there isn't much of collection. So if they do relax the slabs, it's really not going to hit them much. It's not really going to have much of an impact they can really tweak a lot of other line items and make up from that. So if this is something that they might want to touch upon from a point of view of the middle class, giving a feel good, because this is going to be the budget before the general elections. So that's probability wise, I think that's very doable, and numbers also are very supportive in the sense that a very the tax collections are fairly skewed towards the upper middle class and the higher income class. It's not much of collections. It's at 80-20 sort of happens there. So
Right.
there is a lot of room for them to do that if they really do want to set that tone or set that narrative.
Right. Absolutely, sir. My next question to you is, can India achieve the 5 trillion economy by 2025 because of this geopolitical issues that we are currently facing?
So,
Interesting.
so you can hear me smiling, so that itself should be an answer. So let me give you a slightly long answer for this. I'll try to keep it as brief as possible. So we've been saying for a while now that 5 trillion in 2025 is never going to happen, because it's very important to see how this, we're looking at 5 trillion in dollar terms. So whenever you see the rupee weaken against the dollar, all those periods you will see whatever this target number is, it will get pushed forward further and further into the future.
True.
So a 5 trillion is a very likely number for FY28. It is not going to happen anywhere before at FY28, because it is completely subject to where the rupee dollar is going to be. Now, a thumb rule for the rupee that we keep talking about is, every year you should, we are a trade deficit country, so you should always expect the rupee to depreciate by around 3% every year. So to be exact, if you see a 29-year average of the rupee depreciation, you'll see around 3.3% has been the yearly depreciation in the currency. There are
True.
periods depending on flows, it appreciates, and when flows are not really that very supportive, it depreciates. But I think historically it's been around a thumb rule of in and around 3.5%. So if you go by that and historical numbers, we should be around 5 trillion in FY28, and the next 7 years after that, by FY36 or so, you will hit a 10 trillion number. And this is a very, very realistic number, going by a very reasonable rupee depreciation expectation, going by a nominal GDP number of just around 10.5, 11%, which is a reasonable number. So no great shakes on inflation expectations, growth, very, very moderate number. So what it really means is that by FY28, I'm assuming my mental math is not very great, but by FY28, we should have completed nearly, I think, 70 years of independence. So in 70 years, you've actually done 5 trillion from a GDP point of view. The next seven, so just like all portfolios, once your portfolio hits a certain size, the next 1 lakh, the next 2 lakhs takes much shorter time span.
True.
So
True.
similarly, the next 5 trillion from FY28 will actually happen in the next 7 years. So India will add another $5 trillion to its nominal GDP in 7 years post 2028, and the key implication there go is largely for consumer, especially consumer discretionary, and your manufacturing industrials, and your the financials, because India cannot grow if consumption doesn't grow. India cannot grow if financials don't grow. So financials and consumption are no-brainer secular growth stories for India.
Right. Quite an interesting perspective, sir. I'm sure this is
Yeah.
a very good key takeaway for all our viewers and even for us. And my last question to you is, sir, that how much impact can one expect in the markets and the banking sector because of the Adani Group stock turmoil?
I, I don't really know if I should answer that question, but let me put it this way. There's a lot of noise. There's a lot of noise you're hearing. I completely understand. Um, Even from a compliance point of view, there are a lot of noises that you hear. But one must always let me quote a colleague of mine who told me this. I believe in defense strategy. When something gets published in news, I believe the first question they ask is, okay, who benefits from this? So I think if one asks that question as to who benefits from whatever is happening in the markets, what is it to do with such a timely sort of, because it's very uncanny, the timing of this, all of that. So there are a lot of questions, a lot of open-ended questions. You really honestly, objectively look at it, you can see that there are a lot of narratives here, a lot of forces in play. One can't really separate one from the other. But I think as an economy, we're much stronger than this. We're much more resilient, and it's always good that there's a lot of the volatility. Always, when you sort of stir up some noise, it creates a lot of dirt. It creates a lot of noise around it, but it settles, and when it settles in a much in a clearer fashion. I think it's very. I'm trying to keep it as diplomatic as possible, but then I think the markets are much more resilient than what you're seeing. I think
Yeah,
that's
Arjun. I think anyway, I think we invest in a diversified portfolio, so a couple of stocks or a group, doesn't really matter in the long run. So I think Unnati, for your closing comments.
That was a fantastic session, sir. Thank you so much for making the time to grace this event, and also to Sundaram Asset Management. We'll return next month with a new topic and a new speaker. On behalf of Cedrus Wealth Partners, a big thank you to you, sir, and to all our viewers for tuning in such large numbers. Thank you.
Thanks. Thanks a lot. Thanks a
Thank
lot
you.
for hearing me, and thanks a lot, Mr. Bhattacharya, for taking your time. Thanks a lot, Unnati.
Thank you,
Thank you.
Arjun, for giving us this time. Thank you. Thank you, Unnati.
Thank you.